to have a terrific dialogue around trends in the office development and industrial development. We have an incredible panel today with a deep knowledge and experience in both office and industrial development. There are many, many millions of square feet that they have developed as the tenant requirements have evolved. And that's something that we want to really learn and hear from our panelists, some of the insights on the evolution of the tenants and what the tenants are actually looking for in both office and industrial. Two of the panelists are primarily office developers, Francis and Dan, and two are primarily industrial developers, Whitfield and Larry. I would like to just introduce them briefly. Dan Rashin, co-president and CEO of the Rockefeller Group International. Dan leads the company's strategy and business initiatives with an emphasis on development and core holdings in New York and nationally. He's responsible for leading the company's urban development projects across the country, as well as development projects in New York City. Prior to joining the Rockefeller Group, Dan spent 20 years at Heinz Interest, primarily focused on developments in Washington, D.C., New York City, and in Princeton, New Jersey. Whitfield Hamilton. Whitfield is the regional partner, Southeast U.S. Panattoni Development. Whitfield manages development operations in the southeastern region of the United States, and with a concentration in Tennessee and Florida. He oversees day-to-day operations for the company's Miami, Fort Lauderdale, Memphis, Nashville, Orlando, and Tampa offices. Since joining Panattoni in 2005, Whitfield has developed over 6.5 million square feet of industrial, retail, and office space. On the end is Larry Harmson. Larry's the COO of the Americas for Prologis. Larry has overall responsibility for all aspects of business performance for Prologis' operations in North and South America. He's been responsible for capital deployment in North America. And previous to this, and since 2003, Larry's has been responsible for capital deployment in the Pacific region of North America. And then Francis Greenberger, chairman and CEO of Time Equities. As the founder and guiding force behind Time Equities, Inc., Francis Greenberger's earned a reputation for outstanding integrity and an uncanny ability to foresee changing directions and create value in a variety of real estate markets. Francis is the founder and president of the Greenberger Center for Social and Criminal Justice. He's the chairman of Sanford J. Greenberger Associates, Inc., and founder and principal benefactor of AMI International Art Center. So, to start, just wanted to frame up a bit of the conversation. New buildings must be designed for an ever-changing world, and our existing building stock, in many instances, have lost their relevancy. These must be transformed for the same or other more appropriate uses. For office buildings, we really need to understand the knowledge workers and how they use space. We ask the question, what is driving radical change in the workplace design? Because it impacts the design of buildings. We hear the buzzwords like generational diversity, office densification, innovation, technology convergence. But our latest research has revealed new words: engagement, choice in the workplace, and wellness. How will this impact office buildings? From an industrial building standpoint, we must understand how e-commerce is affecting industrial building development. How will the Panama Canal expansion the larger ships carrying 14,000 containers now. How's that going to impact locational decisions? Or warehouses strategically located in urban areas to enable 2-hour delivery? What I'd like to do is to start out with a series of questions for our commercial office building developers, and then we'll shift over and focus in on the industrial development. So first question, Dan, when it comes to real estate in the workplace, what do you think matters most to the people that occupy the spaces you create? There are 75 million millennials impacting the workplace. And I know you've seemed to just sign a very interesting lease that probably has many of those millennials in it, and maybe you can help us understand what's driving office development.
It's interesting. In thinking about this question, I sort of go back to where I started in development, which was in the mid-'80s. And back then, the way we competed was by who had the most granite in their lobby, who had the fanciest elevators, amenities like newsstands, if anyone remembers those, things like that. And we were aiming at the decision maker. And we wanted the decision maker to like our building. We get into the, about 10 years ago, that started to change. And I think it started to change with the whole sustainability thing. We were developing an office building where we talked about, it was a LEED designated building, asked the tenant if they wanted their space to be LEED designated. The answer was no, had no interest. They came back about 6 months later and said, we need to understand sustainability because the young people who are coming into our firm ask us what we are doing about sustainability. Then you come to today, and again, that's been the shift. It's what is going to attract the younger worker, what's going to attract the talent. And for those people, it's about the environment. It's different kinds of amenities. It's amenities that allow people to work kind of when they want, where they want, how they want. It's food type amenities that match the desires and the way those people work. And also it's the technology, it's the backbone. How do you make your building work for the technologies that we have today, but almost more importantly, how do you make it work, or how does it remain adaptable so that technologies you don't even know about are going to be accommodated in the future. So I guess it's a big, I would start with that.
Francis, the world's urbanizing fast. Probably 54% of the population live in cities. By 2050, they're projecting 70% of the world's population will be in cities. The millennials, they want to be in urban environments. They want to live, work, and play in an area that they could walk to. How do you revive interest in suburban office markets? And how does the suburban office market compete with the office buildings in the urban markets?
Well, I think even though clearly there's a trend towards urbanization, there are still many companies and many millennials who are living in and around the suburbs. And I think to the extent that you can adapt the environment of the suburban office building to have some of the characteristics that appeal to millenniums, even if they're not in an urban setting, you have a better chance of attracting them. And I think you've described well some of those things. A lot of it has to do with amenitizing those suburban office buildings. And we look at food, we look at, and not only food, but quality of food, because the old style cafeteria just doesn't cut it, and the kinds of foods that are being served. are important. People are interested in fitness, so you need to have a convenient fitness center where people can go and work out. And we are developing what we call a work lounge, which is a place that people can go to in the middle of the workday, the laptop generation, who don't always like to stay at their desks, and go into a different environment, get a cappuccino from a good coffee bar, sit in a interesting econometric piece of furniture, unusual, interesting. And yes, there's the requisite pool table and ping pong table. There's the large communal table, there are conference rooms. So the chance to be mobile, to work and play at the same time. And these are things that we find millennials who are in the suburbs responding to.
Can I add one thing? You mentioned, Joe, live, work, play, which everybody talks about as the millennials. I think that's okay for today, but I think as we go forward, it's going to be live, work, and educate, as in educating their children. Because so many cities, it's very hard to do that on any sort of a budget. I mean, if you're here in New York, you have 2 kids, they're in nursery school and elementary school, you're paying, $60,000 a year. So those people, I think, and we already start to see it in people we work with, they move out to the suburbs to educate their children. So yes, I think there's going to be, there could very well be more demand for suburban type office space among millennials because they've graduated from live, work, play to live, work, educate.
I think that's a good point. One other thing that occurred to me, which we didn't talk about, is the role of architecture. And one of the things that's become crystal clear is that the millennials' idea of a good workplace is not what developers were once thinking. They want the most modern, the most up-to-date office building. Really what they want is interesting architecture. And we see the tech generation going into office loft buildings, repurposed industrial buildings, or things that have an architectural tradition about them that they find very appealing, or even new development. I know a developer out in LA who redeveloped an area that was destroyed in the riots, and he built very, very creative architecture and was able to attract big Fortune 500 companies to come into this area. It's a legend in his area. So architecture is very important.
Well, it's interesting because I have 2 children that are millennials, and they're having children now, and they still want that really great place to live, and they want the schools, the good schools and all, and they make a reasonable living, but in order to have everything they want, they do have to move out, and it's kind of interesting because we are seeing some of these older corporate campuses in and around the New York metro area that were built in the 70s that have lost some of their relevancy. Some of them, like IBM is now selling, they're just about to sell a campus up in Westchester, and GE's selling their campus. But starting to look at those campuses and figuring out how do you attract these millennials, because they're not always, this generation is getting older now, and their needs are shifting a little bit. So how do you breathe new life into these older campuses and optimize the asset? And we've been seeing quite a bit of increasing the density around these old campuses and adding different uses. But I'm experiencing it. While I see it, I hear it, and I sense it with our clients and the things we design. I experience it with my children. So, I agree with that. Office developers are getting hit with the double whammy: greater densification and greater utilization of every seat. Because the technology has evolved so dramatically, the world is undeniably becoming much more mobile. We're seeing many companies think hard about an unassigned seating model and spaces that have many, many alternative places to work within their environs, whether it's within the office, their office space, or outside and around the neighborhood. How's this impacting your building infrastructure? And what new considerations are you contemplating in your buildings as increased density and increased utilization? Dan?
Well, the best example I can give is we're in the process now of renovating a 2 million square foot building that a tenant who'd been in there forever left. And so all of a sudden it was empty. It was built in 1959. So what was planned for in 1959 doesn't work today. You talked about densification. You got some real blocking and tackling issues. With a lot more people in the building, your elevators don't work right. So you have to go to new technologies, the destination dispatch, things like that. Buildings built in the late 50s, 60s, single pane glass. You got more people, you've got more heat. So you need to be able to dissipate that heat. You have to deal with different electrical systems. You've got to figure out ways to maximize, I think, column-free space. Older buildings have columns. You've got to figure out a way around that, but all the things you talk about in terms of people being able to move around, be able to work different places, you've got to set aside those types of areas. So there's as I said, there's some fundamental stuff, like the elevators. Then there's thinking about, okay, now that you've got all these people on a floor, how are they going to be able to utilize the space in the way they can? So some of it is technology. Some of it is helping them think it through. How do they do that? It's working with architects. It's working with engineers. It's helping people plan, because it's not the old. I remember when I first started, I actually, after being in the business for 8 months, would take a piece of tracing paper and show people where they could put offices. Because it was just an office, a person, a secretary, and that was it. It's much more complicated today, and you've got to be able to respond to that sort of thing.
And then, one of the other major issues is the P issue, the parking, where you get tenants coming in and, 3.5 to 1 is no longer, they want 6 to 1. So that, obviously, parking is always a commodity in short supply and getting shorter, and you have to look at how you can deal with that. We've created, in many cases, additional parking, even where we had what we thought was more than adequate parking.
Yeah, we've seen that in some buildings where, in the old days, even in the suburbs, you tried to reduce the amount of parking because that's what people wanted. And so you would try to get it from 4.5 to 3.5. And now we've got buildings where people are saying we need 6.5, we need 7.5.
Exactly.
And I thought the P issue was a different P issue, which is also an infrastructure problem in older buildings.
That's right. Have you seen any requirements shifting in terms of in 3 dimension? I mean, people looking at ceiling heights or volume as opposed to just the square footage? Especially in some of the older buildings where 8-foot ceiling heights were the norm.
Yeah, I mean, again, if I look at the older buildings that we have, not the one I've been speaking about where we're trying to lease up, but existing buildings too where it's lower, you've got to get creative in terms of figuring out ways to raise things up. So it's taking out the ceiling, which again 30 years ago you never would have thought of. You want a nice clean white ceiling. Having exposed pipes and things seemed an anathema, but today you do have to think about volume. Now, one thing you can't change with an old building is ceiling heights. I mean, you can't change the slab to slab. So we're kind of stuck with things like that, but you definitely see the need for higher space. Now, I don't know whether these 15-foot and 16-foot ceilings are really, throughout an entire space are really going to be necessary as you go forward, maybe a few of them, but you definitely do have tenants who don't like the cramped feeling of a 7.5 and an 8-foot ceiling.
Right, and I mean, you know, everybody wants higher ceilings. So if you still have a drop ceiling, then when you get past the HVAC distribution, you know, you lift it up above the vents and pick up a little height there. And of course, a lot of people, depending on their aesthetic, want the open ceilings. So you rip out what you spent a lot of money putting in recently, and you pray that the trend doesn't change, and 5 years from now, you're going to put all those ceilings back. So it's complicated.
It seems on the older buildings, it seems that you know, people want the higher ceilings, so they've been cutting out in key locations the slab, paying for that square footage, but taking out slabs just to get those wow spaces. So I'm proposing that maybe the landlords should, instead of, you know, square footage has to do with efficiency. I think cubic feet has to do with experience, the type of experience you want your people to have. And I would propose that maybe you start charging rent on the cubic foot basis.
Well, we'll tell them that you told us to do it.
All right, we'll keep going here. So Francis, why don't you share with us what you're seeing? I mean, we're seeing the co-working trend, and it's kind of unbelievable because it seems like many people are in the game, but WeWork seems to be really, you know, are they dominating, and are they here to stay, and what kind of impact are they having on commercial office buildings?
Well, clearly, WeWork has taken a big footprint, certainly in New York City. I forget what the number is, 4 or 5 million feet, something like that. Although I did some micro research, I spoke to a young friend of mine who's in the education field, and he's a solopreneur, and I asked him where he offices these days. And he says, well, on Tuesday and Thursday, I go over to the such and such co-working space, not WeWork, because they have specialists in X, Y, and Z who hang out there. And on Monday, Wednesday, and Friday, I go to this other specialized co-working space because I find I interact with different people there. So it's interesting, not to say that that defines a trend, but I think that the co-working experience, and there are many, many co-working providers, far more than just WeWork, is going to, I mean, one of the things that appeal to people is the ability to network and interact with others that are in related fields. So the idea of a specialization, and if we go old school and we think back to the old trade buildings, where you had all the handbag people in one building, of course that was for showroom purposes, and other specialties, toys. It's that same kind of gathering place that, so I think that we may see more and more sort of themed or co-working spaces that are evolved around very specific subgroups and industries. WeWork is a generalist and would be less compelling from that point of view.
The only thing I would add is I want to see how these people do in a downturn. You know, all of these, we've had a long, steady expansion, we've had a long, steady uptick in rents. You know, when it goes south, what happens when you've got a long lease and short, you know, you've leased long, but you're leasing out short. And it'll be interesting to me to see how they work through that.
Right. I'm happy to say Time Equities is WeWork light. We have no exposure.
Yeah. Well, it's interesting how the people are using the space, and I think it's very much using an analogy of you know, Houston with their zoning. Everybody could go, and you could locate an office next to the retail, next to the factory if you wanted to, and that mixed use actually is kind of interesting now because everybody's looking to do mixed use. I think WeWork or co-work, one of the benefits for the people that use it is that they get a chance to meet with, not just network, but actually solve a problem using multiple disciplines that they don't have to have these people working for them in their own company. But one last question on the office side. Francis, Hudson Yards has sold office condominiums, Related has done that, and seem to be pretty successful doing that. I mean, they're leasing space as well as selling. But is this a trend in New York? Will we see more of this happening in our urban areas where we're selling office space by floor?
Well, it's a very specialized market, even in New York City. What Related is doing is a little bit different because they're selling very, very large spaces, almost buildings within buildings. I first got to know the office condominium format from somebody who's here. David, I don't know where you are, but David Levenstein did one of the first condominium office buildings in New York aimed at not-for-profit groups. And sometime later, off of his experiences, we converted, I think, 3 office buildings in New York. And what we found is that there is a strong market segment, heavily not-for-profits, because they get a different tax structure. They can get tax exemption, real estate tax exemption. And it also, for many not-for-profits, they can raise capital money easier than they can raise operating money. So it's easier to pay for it one time rather than in a rental form. But we find other smaller professional companies, engineers, variety, lawyers who want to buy their space, really across the spectrum. But it is a limited market segment, but it definitely exists, and prices have, in the last 3-4 years, we've seen a dramatic rise in prices, I would say 60-70% in New York City.
So why don't we shift over to industrial development? Industrial is not my forte, but I'm curious about a few issues, and we have some really smart people here that are going to help us through some of these, but to understand it a little better. And maybe we'll start with you, Larry. New supply continues to be disciplined and below demand. Why are we not seeing more speculative development on the industrial side?
Yeah, good question. I hope the smart people are out there. I'm not sure they're
Exactly.
out there.
You know, we were talking.
Anyway.
Wasn't sure. I thought he was talking about you.
No, it's very surprising, I think, that the new supply has been, as mentioned earlier today, pretty disciplined. We expect deliveries this year in the U.S. to be around 185 million feet. We thought at the beginning of the year it'd be 200 million feet. We actually revised that downward. So there is restraint. At the same time, demand is exceeding expectations. Through the third quarter, based on what we've seen year to date, we think net demand this year will be around 250 million, up from 2.25. So that's terrific news in that demand continues to outstrip supply. So why haven't we seen more supply? Whitfield and I were talking about this earlier, and I think there's a number of reasons. But those things would include just generally, it's more difficult for the guy with a pickup truck and the shovel to go borrow out at the bank, right? There's much more financial constraints. You got a lot more skin in the game. The business has become more institutionalized. Information is more transparent, more readily available. There's still a little bit of memory that fortunately is around from the last downturn. And people are just a lot more conservative about how many new buildings they're going to put out there. So I think that's terrific, and let's hope that it lasts a while. We do expect equilibrium to arrive next year, be a little more in balance, but at an overall vacancy rate of around 5% in the industrial market, that's not a bad thing. So the other thing I'd mention is the build-to-suit activity is incredibly strong. About 45% of what we're developing build to suit. I know you guys have a lot of build to suit activity as well,
do.
and that takes a lot of the de-risks the development business. So it's a much more encouraging situation today than it has been in past cycles.
You know, we try to keep that same 50-50 balance to build to suit to spec, and we find ourselves more and more going, okay, now we've won this deal, let's go hang a spec building off of it. We've got a lot more money. I think the whole industry has a lot more equity on the front end going into deals. A couple other things, I mean, Larry and I agree 100% on that those battle scars and maybe the institutional memory and market discipline have a lot to do with it. I think that the volatility out in the greater world today, you know, it's very interesting to me just coming in and out of markets doing the same thing Larry does, where at a macro level, if you're talking to the guys running funds or our investment committee members or our capital partners investment committee members, they're reading the headlines and worried every single day. And then you go into a market, and this is pretty consistent for my markets, the eastern U.S., and I think our demand's the same on the west, that you go talk to the brokers on the street and everybody's got a list of 10 or 12 deals that they can't find space for. So there's this disconnect between the people saying, well, let's be careful about the next bet we put down and just what's really good raw demand right now. So
the other thing to maybe pile on a bit with is that as the audience I'm sure knows, it's getting tougher and tougher to entitle property. Government fees, exactions are increasing, so the cost is going up, and it's just tougher. You know, we're sort of the low man on the food chain, and a lot of these cities, they don't want industrial development. As times have improved, they get tougher with, you know, setbacks and foo-foo, and you know, we don't like trucks and it clogs up the streets, and they don't understand the supply chain. They want everything tomorrow, but they don't want, you know, the facilities that help support that. So it's getting more difficult increasingly, right?
yeah, absolutely. And you know, I can think of a couple million feet just in my world that we'd have under construction that are a year and a half extra of
Right.
whether that's at the Corps engineers level to get 3 more endangered species reports or 3 more tree reports or working on ever increasing wetlands issues. So absolutely, that regulatory.
How is e-commerce impacting industrial development, and how's click and pick impacting real estate decisions for industrial tenants?
You want me to start on that one? First off, e-commerce is somewhere around 15 to 20% of all industrial leases getting signed right now. And I think that goes back to coming out of the recession where you had a massive push from Amazon, who accounted for a significant, you know, just in and of themselves, a significant percentage of the absorption, and they've continued that. And then you have all of the retailers who are playing catch up to that. So, you know, we see big retailers like a Target or a Walmart who are industry leaders that are just now getting started. So as e-commerce has become a larger and larger percentage of our industry, it is just a fractions of overall sales and the overall businesses of some major retailers. We did a recent lease in Memphis with TJX. That was their first e-commerce center. We did a deal with Belk over in the Carolinas. They had to have 500,000 feet literally overnight because they had misjudged how fast their e-commerce was growing dramatically. So everybody's playing catch up on that front. And now you have Amazon leasing infill buildings all over the country, and they're focused on that last mile. So now they're already at the next phase, while all the rest of the retailers are starting to launch their major platforms of that. So, you know, I know you certainly have some.
100% agree, and maybe to take a step back, if demand is 250 million feet, if you look historically at what you'd expect demand to be based on GDP growth and so forth, you'd probably come up with a number, you know, somewhere between 175 or 200 million square feet. Well, we're in excess of that. Why is that? That's largely e-commerce. You know, this demand is incremental to the normal, ordinary demand. So that's a terrific tailwind. Today, something like, 8% of retail sales are e-com. The expectation is that's going to go to 20%. It's growing at, 15+% a year. We've seen terrific demand from this the last 4 or 5 years, but this is a long runway. This has another, 10 plus, who knows how many years to go. As an industrial owner and developer, it's really an exciting time because not only is e-com in general continuing to grow, but it's evolving into last mile. It's taking on different forms. It's becoming beyond Amazon, and that demand is, as you said, 15-20% of all new leasing. It might even be more than that. I mean, it's a huge component of what we do.
So how are the bricks and mortar retailers like Walmart or Walgreens, how are they competing with the online retailers like Amazon? And are they looking to you to help them figure out, or are you coming back to them to help them figure out how they could be more profitable?
Yeah, so I think a lot of them are absolutely, petrified right now. They don't quite know what to do. They're trying to figure it out, should they develop a full e-com strategy? Should they work through somebody else? Should they outsource it? What should they do? Walmart is clearly trying to develop their own e-com distribution network, and they're big. They got a lot of money. They'll give it a go. But if you're a mid-sized guy, it's a much more expensive proposition. But you've got to get into it one way or the other. But brick and mortar is still growing. Brick and mortar retail sales are still growing. There's still positive store openings. There's more store openings than there are store closings. You don't read about the store openings. You only read about the store closings. You read about Macy's and SIORs and so on and so forth. The guys that are really making hay are, you mentioned TJ Maxx, the value guys, TJ Maxx, Ross, Dollar Tree, Dollar General. Those guys are growing like gangbusters. So the consumer wants value. They want stuff overnight, and it's it's bifurcating. And there's going to be some big losers in the middle. And one thing I don't think we hear people discussing and talking about is we will see some fallout from e-com. It's generally felt like everything e-com is good, but there are some startup e-com companies that are yet to make money. Yep. And we've leased some space to them. You guys have leased some space to them. We all have, and we hope their models work, but it's yet to be seen.
But the good retailers, the brand names, they're gonna eventually figure out what they want to be. And what we're seeing a lot of those customers, it's not just they've got an e-commerce facility and they're fulfilling orders from somebody sitting in their house, but a lot of them are using the e-com to drive their store sales. So they're seeing increase in growth, or if they're setting up facilities that somebody doesn't, they don't have what you need today, so step over here and we'll have it in your doorstep tomorrow. So it's not necessarily, mutually exclusive.
It seems that the environment is relatively slow from an economic growth standpoint. I mean, we see some, but it still seems somewhat slow. What's going to drive the industrial demand over the next few years?
I'd say certainly a couple things. One, population growth. Today we have 40-ish million more people than we had when the downturn occurred. All those people eat, consume things, so you just have a greater number of people consuming things. Number two, you've got more SKUs, right? More product proliferation. Everybody wants it in a different size, a different color, et cetera, et cetera. All that stuff's got to go through the supply chain. And then thirdly is the shift to e-commerce. So I think those three things will be huge drivers to the industrial business going forward.
And I'd add there's still a flight to quality where we're building newer facilities. They got LED lights. I mean, we collectively as industry are continuing to push that, and those users are in a lot of cases saving money by leasing more space. Now they may be leaving a B- building or a C+ building, or they may be adjusting from some older facilities into, so those consolidations and just the relentless supply chain drive to get better at what they do. A lot of the deals, at least that we're making, are people saving money in how they're doing it, even though they're signing a longer term lease in a brand new building. So.
That triggered a thought. Functional obsolescence, we don't talk a lot about it, but as industrial guys, we're sort of the least sexy building on the block, if you will. And a lot of the industrial space is being converted to higher and better use. So as that occurs, industrial gets taken out of the mix. And what is that every year? Is it 50 million or 100 million feet? There's some amount of industrial space that becomes obsolescent, gets condemned, gets converted. That comes out, it's got to be replaced by a new building somewhere. So that's something that isn't often spoken about, but that will fuel demand going forward as well.
With the expansion of the Panama Canal, who benefits, the East Coast or the West Coast?
My general view is that it's kind of a net neutral. There might be some slight marginal benefit to East Coast, Gulf Coast ports, but the new ships now are even too big to go through the Panama Canal, and it's still faster to bring product in through the West Coast than rail it to the center of this country. So on the margin, it's going to be a very minute difference. It's not a game changer.
Agree with that 100%. There's been so much, years and years and years of commentary about how all these major shifts are coming. Unless there's a major labor dislocation at the Inland Empire or any of the West Coast ports, I think you'll have temporary shifts, and those guys can, shop around and move around. They're always looking for the best place, the cheapest place to get it in. There's going to be plenty coming through the Panama Canal. Our parks and our core markets in Chicago and Atlanta and Memphis are still, there's plenty of TEUs coming every day eastbound from the Inland Empire. And as you talk to shippers and the folks that are moving those and retailers, they don't intend to abandon the West Coast for East Coast.
Great. Well, we have 15 minutes left, and I think it'd be good to open up to questions from the audience. Any questions on either office development or?
I was just kind of, for the industrial, I was going to say, what are some of the new changes that y'all are seeing here within the last couple of years, particularly with e-commerce, as far as differences in the facilities themselves in some of the markets? Obviously, there's, a million square feet is no longer an unusual thing anymore. But what goes along with that? What are y'all seeing on the new facilities that you're being asked to build?
So, Alan, I'd say for the big guys, certainly clear height. Yep. We built a 40-foot clear spec building in the Central Valley in California, and sort of on the expectation we lease it to an e-com guy, and guess what? They came along, and if we hadn't been 40, we wouldn't have done the deal. Trailer parking for sure, and auto parking. Security, ingress, egress, circulation is critically important. Proximity to labor is huge. That's not a facility design thing. That's more of a locational thing. I don't know what else.
You hit the main ones. It's funny, we have capital is focused on ceiling heights now as the users in some cases, pushing them higher so they don't wake up with an obsolete building on their books or miss some next shift. 3 years ago we did not, LED lights, you couldn't afford to put them in a building. We're not doing it in spec buildings yet, but most of these build-to-suits we're doing over the last 12 months, we've seen a dramatic compression of the prices for the LEDs when you're making a large enough purchase. So we're seeing LED lights is pretty much becoming standard in the bigger build-to-suits. land. I mean, it's just, you need so much more land for trailer drops and car parks for employees, and just getting, seeing that coverage go down and down and down, which is why I think you see a lot of these build-to-suits.
Yes?
From a macro standpoint on the industrial side, is it from a macro standpoint on the industrial side, is it concerning to you that global trade growth has basically slowed to nothing this year? You've got this populist surge around the world right now. Free trade agreements are being reconsidered. Does that concern you at all with industrial demand?
Yeah, I think that's a little concerning. Global trade does drive commerce. I think the larger global trade, the more active it is, the better it is. I think it's better for the general health of the world economy. And this sort of isolationism thing is a little concerning. But we still have a lot of people that are going to consume sort of wherever that stuff's made. You look at the Brexit vote, and everybody was pretty worried about that. Our business in the UK is as strong as it's ever been post the vote. It's terrific. We're 100% occupied. We've got, rents are still going up. So at least if Britain is a microcosm of an example of what might happen, so far it hasn't been an issue at all.
Our industry is obviously based on global trade, as we're building big boxes full of import goods that are then getting distributed out. So it'll be interesting to see how that plays out. And we mentioned the volatility earlier. I think that just, I continue to hear from users and capital saying, we're not worried about 2017. It's 2018 that we're. So everybody's trying to get that one or two deals at a time in, and you don't want to take down land beyond multi-phase stuff. So that seems to be a common theme.
Some of the e-commerce buildings that we design, the tenants are requesting conditioned space. I'm wondering how often you get that request in e-commerce.
Pretty often. I mean, we're conditioning some portion of it, so maybe not conditioning the whole building. I can think of several examples where you've got a particular area where the racks are and the pick modules with people on multiple levels, and we've done everything from build demising walls, and you're conditioning that space to certain temperatures, to dumping air in certain areas. And so, if there's enough people in there, they're wanting to keep them comfortable. And most of these e-commerce facilities are air conditioned. They're spending more on conveyors and equipment and certainly labor than we are on our facility. So they're spending a lot of money inside that shell, and $3 or $4 to get some HVAC in there a foot is a rounding error.
As long as they don't ask for ping pong tables and cappuccino machines, I think we're all right.
That's a good segue into my question. Sorry. Thanks for everyone for being on the panel. Great discussion. I have a question for the office developers as it relates to the company called WeWork. If you've leased space to them or considered leasing space to them, what are your thoughts or advice to the developer as it relates to the RSA, which is a revenue sharing agreement, since it's not a traditional lease agreement? I'd like to hear your comments on that.
I haven't been in, we haven't been in our portfolio in a position to be leasing to WeWork, so I don't really have experience on the revenue sharing question. I would just, as a landlord, be careful to make sure that the business plan that they have for your particular space actually is realistic and isn't strung so tight that any sort of bump in the road could cause a problem. But I apologize, I can't talk to the revenue sharing issue.
Yeah, we don't have experience with that either. As I mentioned, we don't have any WeWork exposure. We do have exposure to places like Regus, but that's not really co-working in the contemporary sense. But I think I have seen some studies of the WeWork model, And I think that the profitability needs to be understood carefully. And, you know, they've managed to present themselves as almost like a tech company in terms of their valuation approach, et cetera. And like a lot of tech companies, they don't have any bottom lines. So it's a different kind of credit than, you know, if you look at the values that get thrown around for WeWork and you compare it to somebody like Regus, you know, WeWork, which makes no money, is here, and Regus, which makes money, is here. So, you know, I'd be careful.
So we've seen a lot of growth over the last decade in the office and industrial markets. What keeps you up at night? What's the number one concern in your mind relative to your portfolio for the whole panel, office and industrial?
For me, the thing that keeps me up at night is, first thing is where we are in this expansion in the economy. As I look back to like 2007 and 2008, you know, every time we were underwriting, whether it was acquiring buildings, developing buildings, our assumptions got tighter and tighter and tighter. And things had to work, you know, you had to get most of them, you had to get almost all of them, you almost had to get all of them in order to make it work. Well, I don't think we're there at this point. One of the things I'm seeing is terms of bank debt getting tighter. And that was one of the first things I noticed in 2008. Now, I wish I realized what it meant in 2008, because I didn't. I don't want to say I saw it, but as I look back, that was one of the first things that happened. Debt terms got tighter, that equity terms got tighter. And so what concerns me is that we are heading toward the end, and I don't know what the end is going to be. Is it going to be a gentle? Is it going to be a drop? I'd like to think it's not going to be a drop, but that's my number one concern.
And we don't have Wachovia to finance all the ones that we shouldn't have done anyway, right?
That's right.
You could get Wells Fargo to open a fake account to do it.
Yeah, I mean, I think it's some degree it's all about interest rates, and you know, the investment markets cap rate compression has been co-occurring with interest rates, not surprisingly, and even though there's a surplus of equity capital in the world today, and maybe the cap rates don't decompress as quickly as interest rates go up, but your costs will, because you've got to pay current rates on it. And deals that are tolerable in a 4% world are a lot less tolerable in a even mid-fives world, let alone a sixes world.
That actually goes towards the question I wanted to ask, and it goes to both product type. What, if any, or how are you able to finance speculative building, both from an industrial side and an office side in today's market?
Well, for us, it's pretty easy. We finance it internally and you know, self-fund. So we're not going out to the construction lender worrying about a construction loan. So it's actually pretty easy. And to answer the other question on what keeps me up at night, I actually feel really, really good about where we are as a company. We got a great team, we got a great portfolio, so there's really not a lot that keeps me up at night. I keep trying to figure out what is it that's going to cause a slowdown, and let's be ahead of it, not get caught. But I sleep fine at night.
Yeah, I think we're, as private guys, we're a little bit differently. We are out putting debt and equity together, and some cases deal by deal, some cases on a fund level. And on the debt question, I mean, we're just putting in more equity, and the lenders are under a lot of duress or stress from regulators continually. So I think that's part of the governor that's been on just making sure there's not, 10 empty spec buildings in every submarket. So we're so far been successful because we're putting enough skin in the game that those loans come, and the equity investments from our good capital partners comes, and in some cases we're funding all equity with good capital partners. So it really is just having multiple buckets or multiple stalls in that barn that we're dealing with. So if somebody gets choked down or slowed down, it doesn't necessarily, and we're able to pick up that capacity somewhere else. And on the what keeps you up at night, it's Larry and I so far pretty much agreed on most of the world views that markets are good. There's a lot of raw demand. We're not seeing spec, as we talked about ahead. You're seeing this next wave of starts. I think we're just trying to be really careful about the next start on a spec building and making sure it's in the right place and it's the right product and well thought out. And and if that's the case, we should be able to get them leased up. And if you've got enough cushion in terms of equity in it, then you're going to ride it out. And if there is some dislocation, so we're just we're trying to block and tackle and really pay attention to that next risk we're about to take on an empty building.
One thing that I was just remembering that a reporter recently asked me this similar question, and phrase a little bit differently. What's something that you think could affect time equities in the future? And I was a little surprised by my own answer, but I think it's pretty clear. And I said failure to innovate. Failure to innovate. And if you think about what we've been talking about, whether it's industrial users, office users of today and the future, I think the real estate business has to stay ahead of what our users' needs are, what their preferences are, and where building systems are, technology, all of these things. And I think the companies that don't force themselves to be very sensitive to all the spectrum of changes that affect our properties, they're the ones that are going to end up losing out as time goes on.
Great. Well, we are just out of time, and I really want to thank our panelists for an incredible dialogue. It was fantastic.